Good afternoon, and thank you very much for attending this plenary session. Let me introduce Professor Michael Dompus. Michael Dompus holds a PhD in Operation Research 2000 from the Technical University of Crete, where he currently holds an associate professor position. His research interests include multiple criteria decision-making, decision support system, business analytics, financial risk management, and energy economics. He has published over 70 research articles in premier international journals, such as the European Journal of Operation Research, Omega, Decision Science, Men and Cybernetics, Annals of Operation Research, Computers and Operation Research, and more. He has also co-authored several books, edited volumes, books, chapters, conference papers, and edited special issues. Since 2011, he is the Vice President of the Financial Engineering and Banking Society, and he has extensive consulting experience with the financial industry on projects related to credit scoring systems, banking risk management, and real estate appraisal. His plenary talk is titled Development of Multi-Criteria Models for Credit Rating, an Overview and Empirical Results for Rating Payment Behavior. Now I give the floor to Professor Michael Dompus.
Okay, thank you very much. I don't know, does it work? Can you hear me? Okay, great. Let me get the pointer. Thank you. Okay. I have the very difficult task to have to complete this very nice event, very nice conference, and after this very nice break that we had, this task is even more difficult. So first of all, let me thank the organizing team, Blanca, Anna, David, and Mila, and of course all of you for inviting me here, in this very nice event, very nice town. And the topic that I'm going to present is about credit rating models, credit scoring, credit risk management in general. This is a topic that we have worked a lot over the years in cooperation with Konstantinos Zopounidis from the Technical University of Crete. We have mainly worked on developing multi-criteria methodologies for credit risk analysis, for corporate performance evaluation related fields. In this talk, part of which, mostly the empirical part, is a joint work with my colleagues Dimitrios Niklis from the Technical University of Crete. He recently completed his PhD on credit risk analysis, and Fotios Passiouras, also from the same university. He is associate professor there. And in this talk, in this presentation, I'm going to try to provide you an overview of credit risk modeling, credit risk rating, credit scoring, which is very important, obviously, issue as I'm going to argue for financial risk management, finance banking, but not also for the finance industry. And I think that through this presentation and this overview, I'm going to try to cover some issues, some topics that we discussed at the end of the previous presentation, like, for example, trying to see what is the context of financial problems where we apply MCDM methods. And credit risk analysis and credit risk modeling is a field where there are a lot of peculiarities. I'm going to argue because there is a lot of supervision, a lot of regulation, and as analysts and modelers, we cannot really ignore these things. And I'm going also, except for the overview, I'm going also to present some illustrative results on a project involving payment behavior rating. This is an ongoing research that we started recently with my colleagues. So just to give you first an indicative outline of the things that I'm going to cover in this talk. So first I'm going to provide an introduction and overview of credit risk posed in the framework from the perspective of financial risk management. Then going to describe some aspects of credit risk modeling. So as to understand what is the problem context and what are the key points that we have to deal with in credit risk assessment. Then focusing specifically on credit scoring, credit rating systems, existing approaches and modeling techniques. Then I'm going to focus and describe how MCDA can contribute in this field, how it can be used in comparison to other methods. And then I will close with an illustrative case study on payment behavior rating with some conclusions, challenges, and future perspectives at the end of the presentation. So I guess that the current status of financial theory is very well known to most of you. Markowitz is considered as the founder of the new era of finance with his works in the 1950s. And then we have the milestones work by Black-Scholes and Merton on option prices, and then from 1970s and afterwards, there is an explosion in the finance industry in all aspects. Nowadays, finance is involved with many things. I have here just a few of them. Obviously, the list is not comprehensive at all, but I'm emphasizing the last one, risk management, because in my view, all topics in finance, at least in perspective and the context which we're dealing these days, they are all related to financial risk management. You can call it portfolio management, you can call it banking, asset valuation, even SRI, social responsible investments. They are all viewed as fields related to financial risk management. And financial risk management has evolved as a very significant topic for many reasons, but I have here one very important one, which is crucial for credit risk modeling: the tighter supervisory and regulatory framework, which has established over the years. I have here a reference to the Basel II capital requirements framework, which was established in 2004. We have Basel III upcoming. This, of course, mostly related to banks, but similar regulatory requirements are actually imposed in many other sectors in finance, and this is an important thing that we cannot ignore. Now, when we're talking about financial risks, one can mention many different types of risk, but the most typical classification, categorization, is the distinction between market risks, operational risks, liquidity risks, and credit risks, and this is obviously the part where I'm going to focus in this talk. One important thing that I have to note here is that although these risks, these different types of risks are listed as in different bullets, they are not, they cannot be considered as separate things. They are interconnected. They are related to each other. One type of risk can lead to another. Sudden market crash can lead to credit risk or to operational risk and so on. But I'm focusing on this presentation on credit risk. And if I want to give a very simple, let's say, definition of what is involved in credit risk modeling, credit risk simply refers to the probability that the borrower will be unable to meet his or her debt obligation. So we have a default event. And this is the credit risk has been common in all regulatory frameworks, at least for banking. The other types of risks have emerged and have been introduced in the regulatory frameworks over the years, but credit risk is a very core issue. Of course, it is timely given the outbreak of the credit crisis that we had in 2007, 2008, but this is not just the sole event where, for which credit risk is important. And although we usually view credit risk as something that is relevant for banks, it's actually not only relevant for them. As I'm going to show you later, credit risk analysis also involves all financial transactions, even non-financial corporations, suppliers, okay, customers of the firms, investors, of course. And we have several new areas which are emerging where credit risk is also relevant. For example, we have online transactions now and peer-to-peer lending markets. So different new areas, new types of loans, new type of services with different requirements, different contexts where credit risk is relevant, and this does not involve simply a bank and the clients. Just some indicative statistics taken from the Bank of International Settlements. This is a graph showing, the title does not appear there, but it is the private credit the credit given to the private sector as a percentage of GDP from 1999 up to the most recent data, the end of 2015. The blue line is private credit to household. The red line involves non-financial corporations, and this is only for advanced economies, Europe, North America, Australia, and so on, Canada. And you see there is an increase from, for example, for households from around 65% to almost 85% in just a decade. Of course, we have then the decline due to the crisis. The private credit to non-financial corporations is a bit higher, but more steady over the years. This is the situation in the Eurozone, where you see a very different picture in the sense that household loans have increased from around 50% to around 65%. This is not a huge increase. And then a small decline due to the crisis. The loans to non-financial corporations are much higher, currently much above 100%. So the problem here is about corporate credit. And this is a situation in the USA, where the time series is much longer, starting from 1951. And this is a very different picture compared to the previous one, where you can see the huge increase, the blue line, in household credit from around 25% in 1951 to almost 100% at the beginning of the crisis, and then, of course, the decline. The credit to the non-financial institutions has increased, but not at the same rate. And you can see here also the volatility in this graph, which actually has to do with different economic problems. Here, for example, in around 1991, we have the problem with the crisis in the Middle East. Here in 2001, we had, in 2001, we had dot-com failures. This is the last crisis in 2007, 2008, 2009 over there. So different context, different problems. The US, for example, we have household lending. In Europe, we have a problem with lending to non-financial corporations, but this, I'm just showing these statistics to emphasize that credit has exploded over the years. So having that in mind, what we mean by credit risk management. In credit risk management, actually what one has to do is to estimate the expected loss from a loan. And the expected loss is a function of three things: the probability of default, the likelihood that the borrower will not be able to meet the debt obligations, the exposure of default, the amount that is, in a simple words, remains to be paid, and the loss given default, which is the percentage of the exposure that is expected to be lost if a failure of default happens. Now, each of these three things can be modeled with different approaches, and I'm citing here a special issue in the International Journal of Forecasting in 2012, where you can find papers covering all these three issues in a very comprehensive manner. For this presentation, I'm going to focus on the PD issue, I mean, methodologies and techniques that we can use to estimate the likelihood of default in some way. But I want to emphasize that credit risk decisions are not simply involved with estimating, for example, the probability of default. One has to take into account a trade-off between losses due to default or profits that one can get from giving good loans to a good client. Okay, and there is actually some debate, some discussion about whether we should use financial measures to assess the quality of analytical models that we use for financial decision making, which is obviously, I think, the correct way of assessing the quality of such models, or we should rely on statistical measures about the quality of the models. Oliver here in a recent paper explains these things in the context of credit scoring. So, as I said, I'm going to concentrate on models for estimating the likelihood of default or assessing the credit worthiness of the borrowers. And these models are referred to credit scoring models or credit rating models. I'm not going to distinguish between them. Although there is a distinction between them, they are not really the same thing. Credit scores are usually expressed in numeric format, and they mostly involve individuals, customers. Credit ratings, on the other hand, they are expressed in a symbolic form. For example, the ratings of Moody's, or Fitch, Standard & Poor's, and other rating agencies, 3A's, triple B's, and so on. And they are mostly related to corporate and sovereign debt. But I'm not going to distinguish between them in the next of the presentation. In either case, we are referring to models that evaluate the credit worthiness of the client, in some way estimate the probability of default or some score of the credit worthiness of the client, and ultimately we classify clients, borrowers, into risk grades, into risk classes. Now, such type of systems and models have actually a long history. One can go back to see the history of Moody's, S&P, and Fitch, the three major global rating agencies, which started their operation more than 100 years ago. When it comes to consumer credit scores, these were introduced in the 1950s by Fair Isaac in the United States. Then in the 1970s, we have the introduction of the US Fair Credit Reporting Act, which can be considered as the first attempt to have a supervisory framework for this kind of models. And then after the 80s, this whole thing exploded, and now credit scores, credit ratings are used throughout the finance industry. Now, there is a lot of criticism of these models, similar to heavy criticism that has emerged after the crisis on quantitative models in general applied to financial risk management, whether they have been successful, unsuccessful, what is the purpose, and so on. I'm listing here some of the main problems noted in the literature about credit scoring rate system. I think the first one is the most important one, the lack of transparency, accountability, and conflict of interest involving the agencies that build these scoring models and provide these ratings and assessments. There is another criticism that they have promoted the explosion of debt. This has to be viewed a little bit carefully in connection with other factors that have led to an to the increase of loans. And then, of course, there is a lot of discussion about their predictive ability, if they provide any useful information. For example, they never predicted the failure of Lehman Brothers, for example, okay, or some other major corporations in the US, for example, the failure of Enron, again. So there is a lot of talk about their predictive ability and their pro-cyclicality, whether they actually predict or prohibit some problems, or they act procyclically, meaning that we have a downgrade, and this downgrade leads to a new downgrade, and then to a new downgrade, and then we have a downgrading cycle with no end. There is a forum discussion published in a journal called Intereconomics for those who may want to find further details on this criticism and how this industry works. But despite the criticism, one has to understand that these things are widely used throughout the finance industry as part of risk management systems. And risk management systems, one has to have into account that risk management does not eliminate risk. No risk management system can eliminate risk. This is not the objective. And these are different things. Risk management systems facilitate risk management, of course, based on risk assessment. This is not shown there. And risk assessments are not crystal balls. We cannot expect these kind of models, irrespective of how carefully and how elaborate or sophisticated they are. We cannot expect them to predict future human behavior, because financial systems have to do with human behavior. They are not purely numbers. Now, they are widely used in consumer and corporate lending. Credit scoring mainly used to evaluating existing customers. Then we have behavioral scoring, credit scoring for new customers, behavioral scoring for existing customers, where we try to analyze the behavior of existing customers. And then profit scoring systems have also emerged, trying to estimate the profit of a loan instead of just estimating the probability of default. And we have systems for special purposes, for example, for project finance, a topic that was presented in a talk in the morning, for shipping, for real estate investments, for banks, or for the public sector and country ratings and so on. So very different contexts. And their use of such models is not simply to decide if one borrower should be given credit or should be rejected credit. This was their main use, maybe 20 or 30 years before, but now they are widely used for loan pricing. David with Mila yesterday presented such a paper where you try to find the interest rate on the basis of credit worthiness score. They are widely used for setting capital requirements in financial institutions, monitor customers, and credit portfolio management, and also for working capital management in non-financial corporations, because every company has to manage the credit that it provides to its clients. And of course, this has to be done in relation to the credit that it receives from the suppliers. Now, we have different types of models. We have judgmental models, which are very useful when we lack historical data. These are models based on expert judgment, taken by credit analysts. They have a very elaborate structure, because given that we don't have historical data to support these models, we have to build systems which provide a lot of information, not just a simple score, but disaggregate this information into partial assessments and so on. CDA models are very useful here. And then we have empirical and analytical models, which are built based on historical data. And this is a field where we have worked a lot. Financial models is also another popular option. These are based on theories like option pricing and use market data from equity, bonds, or say, credit default swaps and things like that. I don't think that a comparison of these different approaches is really easy to do. Everyone has its pros and its cons. Some studies have shown that these different kind of models, I mean, mostly empirical, financial, provide different types of information, so one should consider combining them. But mostly empirical models and financial models are the ones that are widely used in the industry. The model building process is rather standard for an operation research perspective. We have the preparation, setting the targets of the analysis, the modeling phase, preparation, structuring the model, validating the model, and of course using the model, the implementation and monitoring of its performance. Now, in terms of modeling techniques, we have statistical methods. Logistic regression is the most widely used approach. Over the years, data mining and machine learning methods have become quite popular with methods like neural networks, fuzzy systems, kernel methods, or decision trees. I have here some references with reviews and comparative studies if you want to go into that. But I think that methods are very interesting alternatives, not only because they provide accurate results, and I don't think that this is the main, this is the most fundamental issue in credit risk management, but because they are meaningful and comprehensible. I think this is really important for the success of such models used in practice. So what are the multi-criteria aspects of credit scoring? Well, first of all, credit ratings or credit scores, they are ordinal. So we have an ordinal rating of firms, of borrowers, of customers, and so on. We have risk attributes which are expressed in the form of criteria, in the sense that are related to the probability of default, either in maximization form, the higher is, for example, a profitability criteria, the lower is the risk of failure, or the higher the debt, the higher is the risk of failure, or so on. And then we have decision makers. In this case, decision makers are the credit analysts, which are actively involved in constructing these models. And this is a very important thing. These are not models that are built just by collecting some data, putting them as input to a method, taking the result, and that's it. There's a lot of involvement in terms of the credit analyst, the modeler, okay, in this case. And credit analysts want to incorporate in the model's domain knowledge, their expertise. And this has been shown to be very successful in improving these models, in the sense that introducing expert knowledge in the construction of these models helps the models to incorporate information that is not fully represented in the data. Of course, we also, for example, we can eliminate noise and avoid several statistical issues like that, and so on. And also, by introducing expert knowledge, we promote transparency, comprehensibility, and argumentation. And these three are also very important qualities in these models. I mean, there have been many excellent models in terms of their predictive or accuracy or based on statistical measures, but if a credit analyst cannot argue about these models, if they are not transparent, it is almost impossible for them to be actually used in practice because, as I mentioned, there is a lot of supervision, very strict regulatory framework, and a credit analyst cannot really use a method or a model just because it provides good results. This is not enough. And multi-criteria methodologies are well suited to this framework. I have here the main uses of multi-criteria methodologies. They have been used to build judgmental rating systems, where, as explained before, we don't have historical data, so we need to model the expertise and the knowledge of credit analysts. Anguilera and Mazou published a paper illustrating this, such a use of multi-criteria methodology for financing SMEs. They have been used in combination with other analytical models, fuzzy models, case-based reasoning, neural networks, and so on. They have been used to construct models with different performance measures, using mostly multi-objective optimization techniques and evolutionary algorithms, or they have been used as alternatives to statistical data mining techniques. Now, when we build multi-criteria models, we have two main approaches. The direct approach, where we ask the decision maker to provide information, and we have the indirect approach, the preference disaggregation analysis, where we try to construct a model using some data. And the later approach, this one, is one that we have used a lot for credit risk modeling. It's like a regression-based analysis, which is very useful in credit risk modeling, particularly when we have historical databases, and in most cases they exist. So let me explain briefly what this is about. So we have a decision problem. In our case, we're trying to construct a model to assess the credit worthiness of a client. We have some historical data. We assume a decision model, an evaluation model in this case, which is defined by some parameters, for example, the weights of the criteria, the weights of the financial indicators or whatever. And we have a reference set of alternatives, so some borrowers for which we know which are the credit worthy or the problematic ones. And we try to find the parameters of the model using this available data that we have. We have a regression, actually, kind of problem, where we want to find the optimal parameters that minimize the differences between the known status of the applicants and the known status of the applicants and the results that we get from the model. We can do this kind of analysis with different multi-criteria models. We have used mostly additive value functions. Additive value function, an additive value function has this form where the W's are the weights of the criteria, and the V's, V1, X1, V2, X2, and so on, are marginal value functions. So we have an overall assessment of the credit worthiness of a borrower X, and this is disaggregated into partial assessments in its dimension of the analysis. Now, I should note that most rating scoring models actually adopt this kind of assessment framework. It looks so simple, but it's actually quite powerful. It's comprehensive, easy to use, and easy to construct, actually, with preference disaggregation analysis. Of course, on the other hand, assuming that the model is additive, may look a bit restrictive because there could be interactions between the criteria. But I think that the comprehensibility and ease of use are qualities very important for this topic. We have also worked with outranking models. I'm not going to go into the details for this, which are non-compensatory. Now, a very low performance in one dimension can result in a very poor performance overall. They provide very rich insights, much more information, but on the other hand, they are less transparent and much more difficult to construct and infer the parameters of the models with data. So let me just explain how we can estimate an additive value function from the kind of information that we have available in credit scoring. So we have Q ordinal categories. Suppose that category C1 is the includes applicants which are in very strong position. So C1 is the low risk group, and CQ is the high risk group. In credit scoring, we usually start with two classes. The cases, the applicants, which are the borrowers, which are in low risk, no default, and the distressed ones. And we have a threshold-based classification, so we try to build a scoring function that will classify the borrowers into risk categories using some thresholds, a lower bound for category K and an upper bound for category K. So we just need these bounds, these thresholds, to compare the score and do the classification. And to construct the model, we use some data, as I said, for historical database. And we can do it in several ways. Here I have a linear program, which is very easy to solve. And it has very simple structure. So we have one constraint over here, which defines the underestimation error for borrowers. For example, in the first category, the low-risk borrowers, we have an error if we underestimate them, and the score is lower than a threshold. So U here is the underestimation error. Of course, we also have an overestimation error. For example, we may overestimate the credit worthiness of a high-risk client and say that he or she is a low-risk client. So we have an overestimation error. This is OI. Some constraints to ensure that the thresholds are increasing and the weights that sum up to 1. This is a linear program that's very easy to solve even for very large data sets. Now, we can also extend this thing. We can also extend this thing in multiple ways. One issue that has emerged as very important is the robustness issue. And we have worked on, I would say, robustifying this approach in the sense that we try to find models which are most representative of the data set that we have. This formulation that we have introduced in 2007 is very simple, very similar compared to the one that I just presented to you. But now we don't have the constraint. This is only for two groups, the low-risk category and the high-risk category. But we don't have the constraint that the W's, the weights, should sum up 1. Instead, we try to minimize the sum of the weights. And minimizing the sum of the weights is very similar to the principles of rigid regression, for example, because large weights may lead to unstable models, models which are very dependent on the sample that we use, and we may have poor results when we try to use the model in new borrowers, in new loans to assess their credit worthiness. And the same thing can also be used because these formulations that I presented are involved linear value functions. So here, my model is just a convex combination of the data that we have. So this is a very simple linear model. But I can also do the same things when I want to construct an additive model. And an additive model can be nonlinear. I can have marginal value functions, partial scores, which are not linear. The trick is very simple. Just separate the range of each attribute, of its financial ratio, for example, into some subintervals, and then try to find how to score each level of the criterion in these subintervals. Now, this is very easy actually to do, but it has some problems because I have a piecewise linear model, which may be unstable to the way that I'm going to do this piecewise linear approximation. One trick that we have used to overcome this issue is to follow an approach where we combine multiple piecewise linear models, and this gives us a much smoother function, which is much more robust and stable to the data that we use. So let me just close with some results from this application that I mentioned involving payment ratings. Payment ratings is a special type of credit scoring and rating models. They are not really of interest for banks. They are of interest for non-financial corporations. And their objective is they apply to credit relationships between non-financial firms, suppliers and customers, for example. And they are usually either provide a likelihood that the firm becomes delinquent in paying its bills, or another way, this is the case in our case study. These payment ratings provide indicators whether suppliers, customers, and creditors make transactions as agreed or better than agreed. So, for example, if a firm pays sooner or later compared to what has been agreed. And this is very important, obviously, for non-financial corporations because it facilitates working capital management. It facilitates, it helps a company avoid customers which are not reliable or suppliers which are not reliable, so on. And several studies have actually shown that the changes to payment behavior are very important indicators prior to default. Default is the ultimate event. I mean, it happens at the end. Once a firm faces problems which cannot be solved or addressed, it just goes bankrupt or default. But this is the end of the process. Prior to this end, there are many other early warning signals and changes in how a firm pays its suppliers, for example. It's an early warning that something goes wrong. So payment rating models try to assess this issue. Payment rating, to analyze payment rating, the most important things that one has to take into account is the payment history of the firm, what has happened in the past, the outstanding debts, what has to be paid in the future, public records and use, this is very important, financial data, company size, industry risk, and so on. So in this analysis, we used a sample from US. We collected some data from Orbis. This is a database of Bureau van Dijk. This is a business information agency, multinational business information agency located in the Netherlands. And this database provides payment range by Cortera. Cortera is a US credit bureau that provides commercial services for USA and companies in Canada. We used ratings from the period from 2014 Q4, the fourth quarter, up to the first quarter of 2016. We used quarterly data. And all the data that we use, so we have the rating of the firm in a given quarter, and we have the data of the firm in the previous quarter. So we try with the current information that we have to analyze, to assess the risk, the payment risk of the firm in the upcoming quarter. Our final sample has almost 2,000 cases, firm quarter pairs with almost 2,600 US firms. So a firm may participate in our sample multiple times because we observed the firms in multiple points in time. And we have different sectors, agriculture, mining, construction, manufacturing, and so on. We didn't have information about banks or finance industry in general. These are excluded from our analysis. And we used the payment risk segmentation that Cortera provides. This is a segmentation classification in 6 groups, ranging from the low risk group, the low risk group, which is level 6. These are low risk firms whose condition is improving. And then we have level 1, the high risk firms whose position is declining. So 6 risk categories there. Now, one problem that we observed, and this was very strange, is that these ratings varied a lot, even for the same firm in one quarter. I mean, there were some cases where one firm in the same quarter, it started from, for example, level 1, so high risk, and in just few weeks, ended as being a high risk. The opposite. Okay, so a lot of variability, even in a very short time periods, in a few days. And to address this problem, because wouldn't make much sense to have this kind of information in the analysis, we adjusted the ratings into three categories. So we have a low-risk class with cases that are consistently at least in level 4. Level 4, 5, and 6, these three categories are the low-risk categories. We have the high-risk categories, which are consistently rated as low risk or up to level 3. And then we have the uncertain cases, which this category includes cases with a lot of variation. So there is a lot of uncertainty whether these firms are actually low risk, high risk, or whatever. This is the distribution of the sample by the sector. I'm going to talk about that a lot. Now, in terms of the criteria, in terms of the attributes. Now, although rating agencies, they may describe in general the framework that they employ, we usually don't have exact information on the risk rating criteria that we use, that they use. Here we consider three main categories: financial data, size, and sectoral regional effects. Financial data criteria involve financial strength, as I will present later. Size, now size is a rather peculiar thing. We have two conflicting approaches here. One says that firms that are too big, they do not fail. And this is the general idea. This was a general idea before the crisis, but then Lehman Brothers came up. So the story went the other way around. It says that some firms may be too big to rescue. These are two opposite things. But in our case, these two claims do not really apply because, for example, we don't have banks in our sample, so on. However, a small firm is obviously that doesn't have the resources, the means, the strength to maybe to meet the payments as agreed. But on the other hand, a very large company may use its strength to put the pressure, for example, to its suppliers. So a large firm may actually be not a good client for another firm. And we will see that this indeed is the case. And for regional sectoral effects, this is something that multi-criteria methods usually don't consider. I mean, we have criteria. We have profitability criteria, solvency criteria, size, maybe. But what happens if we want to introduce in our analysis things which are not criteria? Obviously, regional or sectoral effects are important. I mean, how can I build, how can I assess the credit worthiness of a firm if I don't consider, for example, the sector in which it operates or the region in which it operates? These are important things. And of course, I may use information about the sector, the competition in the sector, the prospects in the sector, and so on. Or I may use macroeconomic variables to capture the external environment, but yet there are always something missing from the analysis. So there are always effects not captured in the data. And we are going to address that by introducing nominal effects in our model. Now, these are some statistics, the mean and medians of the financial ratios for the different classes. I only want to explain these two things down here. We have the logarithm of total assets as an indicator of size. This is not shown here, but it is demeaned. So we extract the average from this thing. And what we have here is that as firms, this C1 is the average for high risk, for low risk firms, and this is the average for high risk firms. So low risk firms, the better firms, have lower size, lower compared to the mean. High risk firms are larger compared to the mean. But if we see also the square root, the squared logarithm of total assets, we see again the similar behavior. So low-risk firms have a lower average on this squared variable. High-risk firms have a higher average on this variable. So firms that pay, that are good payers, are lower on average, but they are also in the center of this size scale. So we have something like a concave relationship between size and the performance of the firms. Middle-sized companies are the ones that are the best companies here. Too small or too large companies, they are not good payers. As we are going, this is a very simple trick to introduce in our multi-criteria model a criterion size which is neither increasing nor decreasing. The optimal size is somewhere in the middle. Now our evaluation model, I'm going to speed up a little bit because I'm getting out of time. It's a variation of what I showed earlier. So we have the multi-criteria additive model. R and S here are regional and sectoral effects, which depend on where, in which region a company is or in which sector a company is. We have only three classes, as I explained. So two types of constraints. One constraint over here that models the underestimation risk for highly rated firms, the overestimation risk for low-rated firms. We have additional constraints to make sure that the model is in non-decreasing. We need to have an additive value function. We don't have any kind of model. And our objective is to minimize the square root of these classification errors plus a regularization terms for the weights, the regional, and the sector effects, very similar to, as I explained, the ridge regression results. Now, these are the weights of the financial attributes taken from this analysis. So, as you can see here, size is a very important thing, with weights around 25, 27%. Liquidity is also a very important one, with a weight of around 70%. And profitability with a weight of around 14% is also crucial. These are confidence intervals taken not from a resampling or a statistical testing process, but as a process of building the multi-criteria model. Again, they again confirm that the size and liquidity and profitability are important factors. We have some bootstrap statistics which are almost identical here. And these are the marginal value functions of some criteria. And these functions are very important because they allow us to get a comprehensible view of how the model works. We don't have simply weights for the criteria. We also have marginal value functions. And we have to see if they make sense. So, for example, this is for return on assets, for a profitability ratio, which, as you can see, is very low for companies with profitability up to 20%. This ratio had a weight of almost 15%, so it looked like an important thing, okay, because it had high weight. But the fact is that for most companies, this indicator, this financial indicator, doesn't really matter because they all receive low scores. Where it matters is when we have very profitable firms with profitability above 20%. In this case, this indicator contributes a lot in improving the assessment of the firms. And these dotted lines are something like confidence intervals for the whole function. Now, this is for the working capital ratio. It's not shown here. Yes, the working capital liquidity. For liquidity, we see almost an almost linear function. So this thing is important, let's say, for all firms, even the ones for which have low liquidity or high liquidity. And this is for size. Now, this is what I mentioned earlier. Companies that have middle size are the ones that perform best. Two large companies or two small companies are the ones that may have the most serious problems in making payments as agreed. And these are some classification results. As I mentioned earlier, of course, classification is not the only criterion for assessing these models, but this is very useful. We have accuracy, and this is the area under the receiver operating characteristic, which is the probability that a higher rated case will receive a better evaluation according to our model compared to a lower rated case. So with UTADIS here is a standard multi-criteria model for constructing additive value functions. And this standard additive model only considers size and the financial attributes. You see the results are rather low. These are confidence intervals from a bootstrap experiment. We have UTADIS, a variation of the basic model, but we have smooth functions as the ones that I mentioned, a little bit better. And here is the model that I presented, where we combine traditional financial criteria, size, regional and sectoral effects, criteria and nominal attributes, not only ordinal criteria. And this performs much better compared to standard market criteria models. So just to end up, we'll go immediately at some challenges or future research. I think credit risk model is an important thing. It has many facets. I've tried in this presentation to give you an overview of all these aspects that are involved. It's not only, I would like to emphasize that it is not only relevant for banks, but actually for any firm. And it is rapidly evolving and now covers many different things. From online transactions and peer-to-peer lending to traditional mortgage lending, consumer lending, credit cards, and corporate lending, and so on. Now, when it comes to multi-criteria decision-making, some issues that I think we should consider is first to have something that was discussed in the previous plenary talk. We need to have flexible algorithmic implementations in environments which are standard in this field. In my point of view, at least in this kind of applications, even a computer code in popular environments is very, very useful. You don't have to use an overall decision support system, although this would be useful too, particularly in judgmental rating models. We need, when it comes to, again, to MCDA implementation, we need data-driven model validation. In MCDA, we emphasize a lot the role of the decision maker, which is clearly also important in this context. But in this area, we also need data to validate models in some way. And this is an important thing for the regulator framework. We need to be able to work with different types of input data. I'm not talking about quantitative, qualitative, fuzzy, or crisp data, and so on. But I'm also talking about dynamic data. This is something that I didn't cover in this presentation. But this is something that is very important because these ratings should actually be viewed in the context of a dynamic process. And it's very important to be able to understand how likely is a borrower not simply to default in the next time period, but how his evaluation will evolve over a longer mid to long-term period. So rating migration over multiple years, for example, is a very important thing. And then we have credit portfolio optimization, and this is something that I also didn't cover, but this is also very closely related to portfolio optimization, because similar techniques that we use in portfolio management, such as multi-objective optimization, goal programming, that Ralph and Belaid presented in the previous talks, they are also very useful here. Okay, but here we have a little bit more challenging issue, because we have to model the correlations between different firms. And this is not very easy to do with statistical data. I mean, to assess the credit portfolio risk, you need to know how correlated is one firm with another firm. And this is not easy to do as time series of stock data. We have to make sure that our models and analysis comply with regulatory requirements and best practices. And finally, consider integrated our analytical models and techniques with other models established in credit risk analysis, for example, value at risk systems, which are rather industry standard, although they have received really a lot of criticism about their validity. So with this, I would like to stop here and end. I think it was a little bit of time, but okay, thank you very much.